Welcome to the Facts vs. Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Everybody, here's a little intro for this week's podcast. We just heard the news about Ozzy Osbourne. Obviously, listen to this podcast. We're fans of rock and roll, fans of music. Sonu said he has a new guitar. You're going to honor Ozzy for a second, right, Sonu?
Yeah. And we were just talking about Ozzy and that whole thing, the concert with Josh Brown and Michael Batnick back in New York a couple of weeks ago. So, wow. Yeah.
76 years young. So I think I don't know. Are you going crazy train or what are we going with here, Sonu?
Let's try that. Little bit.
That was good. We heard a rumor you have to go under 17 seconds not to pay a royalty. I think you went 16.8 seconds to avoid any royalties. So anyway, so that's a shame. A good one is lost. But with all of that, there's
rest in peace, Ozzy.
Rest in peace, Ozzy. And here comes episode 145 of Carson's Facts versus Feelings. Enjoy it, everyone. Thank you. And we're back, episode 145 of Carson's Facts versus Feelings. Sonu, apparently Coldplay still a band. They are selling tickets like crazy after what we saw go viral. And we're in my Rin Mac hat. Shout out to Rin Mac. It was funny because I listen to podcasts all the time. And Neil on Friday morning was like, did you guys see this thing at the Coldplay concert? And now, like 2 days later, it's literally not nationwide. It is bringing the globe together. But apparently, people are actually listening to Coldplay again, a band that I didn't even really know still around. But apparently they are. And how about that?
Concerts are supposed to be pretty good, except I don't know. Unless you're, I suppose, having an affair.
I guess not. A lot of memes on that. Brought the country and the world together. So you're watching some kids. I know we have a deadline. What are your kids doing for the next 40 minutes? Because you're kind of, what's happening here? We're going to do this podcast, but
they're having toast and Nutella for breakfast. So mom's not here.
Right.
That's what I did. It's easy. I'm not getting, like if I ask them for what do you want for breakfast, they're like, not this, not that. I'm like, can I give you toast and Nutella? You're like, yes. Mm-hmm. Okay, that's what they do.
Easy.
It's easy. I can come and do the podcast.
Easy. He said, Dad's got to work. Just don't beat each other up. Be good. Give me 40 minutes and let's get this done.
Exactly. But it's been good so far. I took them for Superman yesterday.
Yeah.
And
did you fall right asleep? Did you fall right asleep or no?
I did fall asleep in between. I feel like this. I don't know if you've seen it, and not to go off a complete tangent here, but I thought Superman got beat up too often. Mm-hmm. How does Superman get beat up, right? So anyway, that was a bit of a. It was like, this doesn't quite fit, but it was a reasonably good movie, I suppose. But I got it happen.
Yeah, sounds like the Bears getting beat up, which I guess we're going to talk about here. We've got a lot of things to discuss. Right, let's start with earnings. Let's start with earnings. I mean, markets at all-time highs. We're going to talk markets. We'll get into that stuff. But earnings season just started. The big banks came in. Most of them beat. What I thought was impressive was they sold off kind of on the news. I looked at the earnings. I didn't think it was that bad. Then late in the week, they kind of bounced back. Maybe it was to sell the news. Like something like 83% of all companies have beaten on revenue and on earnings. There's 112, I believe, reporting this week. High level looks pretty darn good. What do you think about earnings so far, Sonu?
I'm just looking at this earnings dashboard that Wisdom Tree, our friends at Wisdom Tree put out.
Shout out Wisdom Tree.
Which is neat.
And they just put out their mid-year outlook. I saw they sent us their mid-year outlook. So great stuff. So
good stuff. Shout out to Jeremy and his team there.
Yeah.
About 14% of companies are reported. So that's about 63 out of 500 companies in the S&P 500. The average surprise is about 2% on the sales side, top line, 7.7% on the earnings side. So pretty good. That's the 7.7% earnings surprise on average is better than the historical average. So that's good. And long way to go, but a good start to earnings.
Yeah, I mean, I don't think we need to say too much more. I'm sure we'll dig more in the next 2 weeks. I mean, there's a ton of big names that are set to report the next couple of weeks. All in all, why are stocks at all-time highs? One of the reasons, as we've talked about, our earnings continue to surprise to the upside. Forward earnings estimates hitting all-time highs. Profit margin forward estimates are hitting new cycle highs. Those are the dual tailwinds this bull market. We've talked about those for a couple of years now. Not much has changed, but again, so far, so good. I want to talk about Mr. Powell. He's had a boy. We've really focused on him last week. I'll tell you. I mean, I don't even know the latest if he's rumored to be fired or not. But let's go there because there's a rumors Powell might be fired, and that came out last Wednesday, like in a big way. That was out there. I know we call it like a litmus test. You've got some stuff you're going to talk about. Market sold off. President Trump said no. That's not true. Like 90 minutes later, I don't know, something like that. Then the market recovered. What did we learn? What you talked about our advisors about this yesterday in a really good morning call discussion. What did we kind of learn from if Powell potentially were fired, Sonu?
When you manage portfolios, when you're taking bets one way or the other, and you're wondering about what happens if X, Y, or Z happens, you never know. Right. We've been in market. We've been managing portfolios for a long time. You never know that. It's very rare, almost never, that you get an actual event study. And that's what we got Wednesday, July 16th, 11 a.m. Trump indicated he'll fire Powell. He even apparently showed a termination letter to House Republicans. And at the time he said, all of them agreed with me that, he's he needs
everyone
to get
agreed.
Yeah.
Everyone agreed.
But I'm too conservative, so I'm not firing him. So an hour later, he rolls that back. He says, no, we're not planning on doing anything. He did qualify it, saying, unless he has to leave due to fraud. So the door is wide open. This morning, I get, a note from Bloomberg saying Scott Bessent, the Treasury Secretary, is upping the pressure on Jerome Powell. And it's not like, okay, there is a case to be made. They have to lower rates. Chris Waller's made that case. I think I'm in agreement. Now I think they're in a bind. We can talk about that later when we talk about inflation. But Bessent's talking about this whole Fed building renovation thing. Like, okay. But anyway, we got that event study for 1 hour. What happened? Stocks fell. The S&P 500 fell 0.8%. The Russell 2000 fell 1.4%. Both recovered, once Trump pulled things back. But, there's your answer a little bit. What happens if Powell gets fired, right? But then I think the bond market is more key here. Right. What would you expect if Trump puts his person in, or persons, if he fires the entire board of governors, which at this point I wouldn't put it past them? You would expect short-term interest rates to fall because that's what Trump wants, right? So 1 year yields fell, 2 year yields fell. Like I said, not a huge surprise if Trump gets this guy in, right? They're likely to drop rates. But long-term yields rose, perhaps also not a surprise because inflation expectations have been rising. And part of that is we're starting to see tariff-related inflation. But part of it is also, what if the Fed keeps rates too low for too long? So long-term yields rose. The dollar actually fell. If yields rise, you would expect the dollar to increase because, U.S. yields are more attractive than the rest of the world. The dollar would go up, but the dollar index actually fell 1.2%. By the way, it didn't recover all the losses, even after Trump reversed his call. And then finally, last thing, gold increased, but that's not a surprise to us, right?
No, I was going to add, great stuff there. I mean, listen, the dollar's been in a downtrend. It's popped a little bit. The dollar on Monday hit its 50-day moving average, had one of its worst days of the year. So it continues that downtrend. Gold, obviously, it's not perfect, but historically kind of trends inversely with dollar. But gold's also in an uptrend. So we like that. I will say, I'm going to read this here. Shout out to Phil Rosen, our friend over at Opening Daily Bell. Quotes us a lot, and it's a great daily email. This morning, he's talked about some of the recent things. And I've read this before, but I think it's funny. President Trump has called Jerome Powell. I don't know exactly how recent, but this is just recent. These are a few things from our friend Phil. Powell is a knucklehead. Jerome Powell is a real dummy. I mean, I can't even say these with a straight face. It's impossible not to giggle when I read these. Mr. Too Late. And he should cut interest rates by 3% and do it immediately. So shout out to Phil there. Yeah, I don't know. Anyway, I thought that was funny from Phil. Good stuff there. But so listen, that's what we know. But we also know that Waller is kind of one of the generals. Waller really wants his job. Last Thursday, Friday, Waller's in the news. I mean, Waller's pretty much said, I'm going to vote for an interest rate cut in July, which is what I think in 10 days. Next week. He said, hey, listen, inflation's not a big of a problem. If you peel back the onion, we're going to talk about inflation. Maybe we kind of agree there. He also says the labor market's maybe cracking a little bit more. Maybe we kind of agree there. And the other thing he said is tariffs are not inflation down the road. It's really a one-time tax on pricing. That's what I want to ask you, Sonu. Interesting discussion. I mean, Waller's a bright guy. Is it should we look at tariffs like a one-time kind of tax on pricing versus constant inflation down the line? I mean, how do you view that?
I think so. I've said it in the past. I
think Waller listens to this. That's why literally everything he's just said is kind of stuff we've been talking about. So I don't know.
I think it is a one-time, but then optics are horrible.
Well, you're calling out your boss. I mean, imagine us doing that to Bert. Hey, Bert, we love you. I'm not calling out Bert on a live podcast,
But even beyond that, I meant the optics of inflation. We know tariff-related inflation is likely to show up. We can talk about the inflation numbers too. Mm-hmm. But think about, let's say July, they're not going to cut rates, right? Yep. But let's say Jackson Hole, Powell comes out, and let's say August inflation numbers are sort of like what we saw in July. Well, it was June numbers. Let's say July numbers also similar. Okay. Not too hot, not too cold. It's okay. We can live with it. We can talk about what's going on under the hood. But let's say Powell comes out of Jackson Hole, signals a rate cut in September.
Okay.
All right. By then, let's say core PC is about 2.9% year over year, which is, it's well above target, right? Now, we all know why, because of lagging stuff. There's some tariff inflation, which is probably going to go away. It's a one-time thing. It's not a persistent rise in inflation.
Right.
So it's so then, think about just before the September Fed meeting, we get August data. August data is hot, right? I mean, this could very well happen because who knows what happens in inflation data. They basically have egg on their face. Yep. Here they've been signaling a rate cut. And the moment they cut rates, or let's say they're signaling a rate cut for September, let's say inflation data comes out, core PC is at 3%. That's what I meant. The optics look terrible. Suddenly they're like, oh, you've missed. Think of everyone that said, you missed transitory here. Now you're saying tariff inflation is transitory.
Mr. Too Late. I mean, Trump's calling that. Honestly, a lot of economists, then maybe not calling it to his face, but maybe it is Mr. Too Late. We were saying it back in January they should be cutting. Yeah. I mean, we said that. We laid that out. Mm-hmm.
And that's a fix, right? If they had cut back in January and March, right, based on where inflation is today, rates are just simply too high. Yeah. I'm not saying rates should be 1% like Trump is, right? But they can be closer to 3%, maybe even 3.5%. It doesn't have to be 4.5%. But if they'd cut in January and March before this whole tariff mess, we would have probably been closer to 4%. And then they could have said, oh, you know what? Now we are waiting, see everything through by the end of the year, maybe think about cutting rates again. Now, I don't know that we'll get a cut in September. Right? I think even the market's putting it closer to a coin toss or just 65%, which is as close as to, pretty much 50-50, right? So I think we may get a rate cut only in December, if all goes well. Now, if the labor market breaks, I think we get a rate cut, but I think we have bigger problems if the labor market breaks. Anyway, that's where I am.
Okay. No, I mean, listen, we talk about this stuff every week. Powell is in a tough spot for a couple different reasons. The walls are caving in all around him, it feels like. But look, let's go forward. I mean, kind of the cousin to this conversation, I think we'll call it, is inflation. We had the PPI, we had the CPI last week. Both came in, kind of fine. In fact, the PPI was much lower than expected. One thing about this, the Bloomberg has 50 economists that give what they think the economic data will be. The PPI came in lower than all 50 economists, reminding us of the great joke, why did God create economists to make weathermen look good, is the great joke there. Except for this guy's hat I'm wearing. Neil's good. There's some good ones out there. But nonetheless, Sonu,
Neil's not a traditional economist.
Well, no, that's very true.
Maybe.
That's I think the way you have to. I think we've learned this cycle. You can't just follow yield curves and ISM. Oh, LEI. I saw the LEI headline yesterday. LEI was weaker than expected, blah, blah, blah. I said, thank God. I don't want to see the LEI say things are good. It's time to sell. I'm half joking. I'm almost like just half joking on that. If LEI says things are great, that's when we change our models. That's when we change our overweight, because something that's been dead wrong for 3 years. Yeah, I might not want to agree with that one. Anyway, we don't need to get any more in that if we don't want to.
I'll write a blog on that tomorrow, by the way.
Yeah, there you go. There you go.
So carsongroup.com/research. Yes.
What do you think about that CPI and PPI? I mean, because it's interesting, because there are pockets or inflation are showing up where you'd expect it to, but the shelter rents, owner's equivalent rent stuff we've been talking about is kind of offsetting it, right? Is that what you see in inflation?
My big picture is not too concerning. There are inflationary forces coming from tariffs, but there are massive disinflationary ones too, right? That's what's happening under the hood. Right. Last 3 months, headlines running about 2.4% annualized. CPI, Consumer Price Index, running about 2.4% also over the last 3 months.
Okay.
Like I said, there are big disinflationary forces. What are those? One is shelter disinflation. All through 2023, 2024, you and I were talking about how shelter disinflation's not showing up in the official data. Yep. It's lagging private data. Well, it's showing up right now, and that's helping push overall inflation down. Mm-hmm. Yep. Right? So, and there's more disinflation to come if you look at private market rents. So that's happening. And then you have other disinflationary forces. This, I would say, is a little more worrying, and why I think rates are too high. Airfares. 5 straight months of airfare prices going down. Last 3 months, it's down 21% annualized. Hotel prices, 4 straight months of declines. Last 3 months, negative 15% annualized. Look, these are very cyclical areas. What does that, what do those numbers tell you? It tells you aggregate income is easing, payroll growth is slowing, wage growth is easing, and rates are too tight. That's it.
So let me jump in 2 things here. Our friend Tom Lee over at Fundstrat, Tom noted this. 5 straight months now, CPI is coming lower than was expected. So that's interesting expectations. And as someone who gets to travel the country a lot and work with our amazing Carson partners, do industry events, different things, a lot of times I go to the West Coast, right? And when you go from the East Coast to the West Coast, you do the math, you get to your hotel a lot earlier than you probably would normally. So you get there at 9, 10, 11 o'clock. And I'll tell you, anyone who does this, you're playing hotel roulette. You're praying that your room is ready because you're tired. You probably have a couple hours to kill. There's nothing better than a 2-hour hotel nap before you got to get on your day if you're on the West Coast, if you flew to the West Coast. What I'm getting at, Sonu, is there was a time, year or 2 ago, I'd rarely have my hotel room ready. I'll tell you, just about every time I'm doing it. Now, this could be anecdotal. This could be just me, or I could just be a lucky guy. But I do think what you're saying is true, that demand is a little bit softer pertaining to hotels. And I'm not hearing nearly as much. Remember back in the day, let's call it 2022, 2023, we'll give you $800 to take the next flight. We'll give you $1,000 to take the next. There's a family of 4. We overbooked. I don't hear that stuff either anymore.
That's true.
The plane seems full. Yes. The plane seems full, but they're sure not giving a ton. Because half the time I'm like, I love my family, but man, $1,000 to wait 5 hours? I don't know. I mean,
3 of you with kids, you guys are waiting for 5 hours.
I'll tell you, that sounds pretty good. But I'm not here. And again, totally anecdotal. I get it. But this is a guy who's on the road a lot. That's what I'm seeing. So I'm with you that, the anecdotal part and the softening part does say this economy is slowing. Maybe why the Fed should be cutting. But that makes sense to me, that inflation part. Is easing a little bit. Go ahead and add what you want there.
No, that's a good point. Over the last 7 weeks, I've taken about 4 trips. And now that you mention it, I didn't notice it, but that's true. I haven't heard that.
Right.
So. And the plane's full, right? But that could be a function of them cutting routes and things like that. Right? Yeah. And by the way, that shows up in PCE inflation. In PCE, it doesn't quite show up in CPI because of how airfares are calculated, things like that. But some nuances there. But on the other side of this, all this disinflationary stuff, we are seeing tariff impact, right? Everyone's been talking about where is the tariff impact? Well, at the headline level, you won't see it because, you have big things going down, right? As we talked about. But tariff impacts are showing up where you expect it to. Goods. Yeah. Household furnishings and supplies. This includes even washing machines, things like that. That's up 6% annualized over the last 3 months. Right? Recreational commodities also up 6-7% annualized last 3 months. So things are heating up there. Food prices. Now, this is a little unexpected, right? But, we've got some tariffs on tomatoes. Coffee prices are going up, things like that. Groceries are up 13% year over year. Restaurants, you and I eat out quite a lot when we meet, right? Even when we are on the road. Last 3 months, seated restaurant prices, right? Dining out. That's up about 6%. right? That's pretty hot. And we know it's not hot because of wage growth, because wage growth is softening, including for leisure and hospitality workers. Rents are not going up. We just talked about that. It's because of food prices, grocery prices, things like that. Food prices are going up. And I think one symbol of this, a symptom of how you think about it, diesel prices. Diesel prices are at their highest level since last August, since last summer. It's about $3.73 a gallon. So that obviously feeds into transportation costs for food, things like that. So we are seeing tariff impacts in some of these places. But that gets to the fact that, the Fed is in a fix. They know tariff impacts are showing up. And the optics of saying, oh, we're going to cut rates when the next print could be hot. I mean, what is sheltered as something funky, right? And then you get a 0.3% reading on core PCE, and the Fed looks like idiots, right? So I think that's the bind, which they shouldn't have been in if they'd cut rates in January and March. So we're back to that. I won't go on about that.
No, we're back to there. I guess the bottom line is there are positive parts of the inflation backdrop. There's some potential negative parts of the inflation backdrop, but it's probably much more benign than we were being told 3 months ago. Right, 3 months ago, we were being promised a big spike in inflation. We're not seeing that. And a lot of it does have to do with shelter and rents and hotel prices and airline prices, some of those things that we're not shocked to see improvement there. But the bottom line, the market doesn't seem to care, right? Yesterday, which was, I guess, Monday, S&P made its 10th new high of the year. So literally, by the time people listen to this, might be at all-time highs. We'll see. Here's an interesting stat, Sonu, that I just compiled last night. The S&P 500 has closed above its short-term 20-day moving average 60 days in a row. It's 60 trading days. Now, that is the longest streak. Remember, a 20-day moving average is something you should be oscillating around, like above, below, every couple days, to be honest. I mean, maybe 10 days is a long time above it, but 60 is crazy.
So you're saying it should be noisy, right? There should be some volatility, and we haven't seen that.
It should be, but what this is telling us is the stuff we've been saying for a while, that this is a rare strength off of a major low that, here's what I'm going to tell you, likely suggests higher prices. So we'll share this on the YouTube channel right now. This is the longest streak since 61 days above in late 1998. Okay, so this is just incredible amount of persistent buying pressure and strength above the 20-day we've seen in a long, long time. But Sonu, the last 4 times, going back 50 years, we've seen this many days above the 20-day, which is 60 days. You start the clock right now on that 60th day. You start the clock. 1 year later, out of these 4 times, S&P's up every single time, up about anywhere between 20 and 26% a year later. 3 months later, never lower, going back all the way to 1950 when you have this signal. So again, I call this one of those it is what it is signals. When you stack it on top of so many other things that I've been pointing out, this is still a bull market. This is still a healthy bull market. Maybe we're due for some consolidation, would be perfectly normal. But like I look over at gold went straight up the first 6 months. It's consolidated the last couple of months. Now it looks like it wants to go higher again. I mean, markets can consolidate sideways through time. Doesn't mean you have to consolidate through price. They can consolidate through time. And I as strong as things are, I think it continues to suggest the second half of this year is going to be a pretty good one for investors if we've laid out. One other thing I want to point out about is I'm an old school John Murphy listener, right? Message of the markets. What's the market? We can talk about inflation in the Fed, but what's the market telling us? When I look at the leadership, cyclicals over defensives making new highs, high beta over low beta making new highs, momentum stocks are still strong. We're seeing industrials, we're seeing financials, we're seeing technology breaking out to new all-time highs. Those are the things you want to see leading. What's lagging? Healthcare, some energy, some materials, utilities, not as much. But I don't call this your father's utilities anymore. No. They're a little stronger. Staples. I mean, our friend JC Pretz had a great chart that showed if you look at technology relative to staples, breaking out to the highest level ever, breaking out above the 2000 peak. So to me, these are signs that we could have a big pullback due to scary headlines at any moment. Trust me. And August is around the corner. We'll probably talk more about August soon. But August, for whatever reason, squirrely stuff happens in August, so we'll get there. But the reality is this is still a bull market being led by the right things. And Sonu, you said before, I'll turn it to you right now, momentum's a beautiful thing when it comes to investing, right?
Yeah, and we like momentum. Now, you just have to be careful of which version of momentum you pick. Our colleague Grant Engelbart wrote a great piece on this.
Yes.
I mean, momentum is great, but be careful of which momentum you pick, right? But going back to your point about utilities, I thought that's interesting. And I think I may have mentioned this before, but a lot of this is about AI, right? And now for
totally,
AI,
totally.
I don't even look at technology. I look at utilities. What are utilities doing? If utilities are up, yes, the AI story is strong for that day or that week or 2 or 3 weeks. Yeah, utilities are up over 12% year to date. Technology is up over 12% year to date. Now, the good news is industrials are the leading sector, right? And you kind of want to see that. It's actually surprising that industrials are outperforming the S&P 500 by as much as they are. Yeah. The Spider Industrials ETF is up about 15.5%. Yeah. The S&P 500 is up just under 8%, about 8%, something like that. That's a big outperformance. And usually industrials track the S&P 500. So there's something going on under the hood, but it's a good thing.
Oh, it is. And no one's talking about that. I mean, nobody's talking about industrials doing well. We're fine with that. We like to see that for sure. All right, let's see how we're doing time wise. We've got about 15 minutes. What do you want to
stay on the stock theme and talk about sentiment? And
let's do.
We have some meme stocks.
Yes. I'll start with some of this big sentiment. So we'll share again on the YouTube channel, David. This says chart 28 is from the Bank of America Global Fund Manager Survey. There's a lot of ways to look at sentiment. Yes, sentiment has come back a lot if you look at like a relative basis the last couple of months. But remember, sentiment in a lot of ways we look at the world back in April was lower than it was during a 100-year pandemic, during the great financial crisis, during the bear market of 22, during lots of other bad times. I mean, which is kind of crazy. And it's another reason we said, listen, I said sentiment's too over the top. It's not as bad as people tell us. We're going to come back. Well, now here we have. But what we're sharing is just, again, this is looking at the what level of risk you're currently taking relative to your benchmark. They ask portfolio managers. And it's come off the lows, yes, but nowhere near the peak. And it's just kind of normalizing. I mean, when I look at the AAII sentiment poll, which is, let's see if I get it right, American Association Individual Investors. Hey, got it. There we go.
You presented in front of them, too.
I have. You think I know? Quiet, Sonu. You think I know what they're called? I presented in front of name, also NAIM. I never get that one right either. So anyway, the American Association of Individual Investors, 39% bulls, 39% bears. I don't know. That doesn't sound over the top to me. You look at hedge funds and large speculators, they have been fighting, kicking and screaming this whole rally. They've increased their short bets the last couple of weeks. They've got the most shorts, according to CFTC data, since the lows in April. Okay, so sorry, hedge funds. I think you're wrong again on this one. The Global Fund Manager Survey, as we just shared on the YouTube channel, had a couple other things. Yes, the last couple months, a big spike, but reality is people aren't taking risks. People still are very uncomfortable. You and I talk to clients every day. We talk to advisors every day. I never get asked, hey, this is really good. How high is this going to go? I mean, that's just that's an impossible question someone to ask. So it never happens. Looking at overweights also on equities is again from the Bank of America survey, nowhere near previous peak. And then the NAIM, National Association Investment Managers. There's an A in there somewhere. See, I don't know their name.
I'm just laughing.
NAIM. That's what I'm going to call them. Sorry for. I don't know. There's an A in there somewhere. It's got to be Association America. I don't know. Whatever those two A's stand for. Down. It was fairly high a couple weeks ago, but down 2 weeks in a row. So yeah, there's pockets of optimism. You're talking about meme stocks. Maybe we're seeing some of that there. But overall, Sonu, to me, this is another reason that this bull market is not over. This summer rally is not over. We're just not seeing over the top optimism on sentiment. Tell me now, the meme stock, hopefully we're not back to 2021, but we've had some crazy moves in some of these stocks. What are you finding out there?
I think the difference is the professionals are pretty upset. I think if is upset the right, maybe upset.
Yeah, I think professionals you can say upset.
That. Yeah, but the retail's like gung ho, right? And especially this corner of retails that's plugged into the options market.
All right, Sonu, time out. Sorry, I had to find it. National Association of Active Investment Managers. Active. Apologies. I have spoken in front of them multiple times. I'm sorry, guys. I'm a big fan. I mean, I love the organization. Do a lot of cool stuff. But anyway, active, not anyway. Take it away, Sonu. Sorry.
What were you talking about? Retail investors.
Meme stocks, yeah.
Especially those plugged into the options market, because I don't think all retail investors are plugged into the options market, but there is a large cohort that is, right? And so guess what? Gamma squeezes are back. Remember what happened to GameStop?
Oh, yes.
Back in 2021, January. So before I explain what gamma squeezes are, all of that, here's a stat, right? Monday, July 21st, and even last Friday, July 18th, the Russell 2000 gapped up by almost 0.71%. But then by close, it pulled back 1.3%, 1.2%, right? Those are big moves. And even as the S&P 500 closed, at the highs for the day, or it was at least positive, right? So if you look under the hood, we saw some huge reversals for, these meme stocks. Top of the list, Open Door. Do you know what Open Door does?
I mean, I've seen it before. I've seen it before, but I really don't know. Yeah.
I'm like, so I looked it up. I was like, okay, it's an online company buying and selling residential real estate. Maybe there's something to do with the blockchain or something. There is a theme amongst the top, stocks, that these meme stocks. There's a theme of crypto in there too.
Mm-hmm. Oh, so, no doubt. Yeah.
So anyway, Open Door, they opened up yesterday. Massive. They were up 120% on Monday. And then they paired the gains to close only, and I put only in quotes here, only 43% higher. Over the last 6 days, it's up about 300%, something ridiculous, 320%, right? So, but you see these massive intraday moves, and then you look at, a bunch of other stocks. There was a nice tweet from Alpha Charts. Open closed 35%. It pulled back 35% intraday. And a bunch of other stocks pulled that 16, 15, 14% intraday. So there's a lot of movement happening, especially in this meme stock. Even something like CoreWeave pulled back about 7% on Monday, right? So what's happening here? You remember Wall Street Bets, that Reddit site?
Oh, yeah.
So Open Door, yesterday, this is Monday, 2.25 million call options were traded. That's the third highest daily total of 2025 for any U.S. stock. That's only behind NVIDIA and Tesla. This is a little tiny, whatever the company does, right? And on Monday, by the way, more calls were traded on Open Door than on Tesla and NVIDIA combined. Even AMC and GameStop were never able to do this. So, so that's what's happening. So then you talk about, okay, what does a gamma squeeze mean, right? And when you talk about gamma, you have to bring in delta, which is, these are all Greeks, as we call it, within the options world. You and I started in the options world when we started our careers in this business. Think of delta as a beta for an option, how exposed you are to the underlying stock, right? And at the money call option will have a delta, a beta of about 0.5. Out of the money option will have a delta much lower than 0.5. In the money call option will have a delta much higher than 0.5, right? And put options. So call options have positive beta, positive delta. Put options have negative, right? But delta is dynamic, right? Delta changes as the stock moves. So what happens is, let's say a whole bunch of retail investors buy a ton of really cheap, in dollar terms, out of the money call options, right? Stocks at $1, they're all buying $5 calls or something like that. So it's really cheap, some cents or something like that, right? This is what happened to GameStop a couple of years ago, what happened to Open Door on Monday. Now, who's selling them these options? The dealers and market makers. So, and now because they're selling these call options, they're short delta, they're short beta, right? And now these market makers don't want to take any directional bets. So what do? They hedge it. They hedge it by buying stock, right? So the positive beta from the stock cancels out the negative beta from the call options that the dealers and market makers sold. Now think about what happens if the stock price starts to surge. The beta or the delta on these call options starts to move as the price gets closer to at the money and even beyond that. So now what do the dealers have to do? They have to buy a lot more stock, and that leads to the stock price rising even more, which in turn leads to call options rising further in value. And you see, there's this positive feedback loop, right? You get this massive surge, and then all you need is something to break the other way, and then it just plunges. That's essentially what's happening. That's a gamma squeeze. There are multiple gamma squeezes going on. I mean, back in the day in 2021, it was just GameStop for the most part. Now we are seeing a whole, like Luke Kava over at Sherwood put up this chart. I mean, we'll put this chart up as well. 21-day average call volumes have surged for about tons of different stocks. I mean, there's a chart where he's got 8 stocks. We're talking about Rocket Labs, Circle, Open Door, Red Cat, Galaxy Digital, Lightwave Logic. I mean, I'm guessing all this has to do with crypto, something to do with crypto. But there's this pocket where things are getting a little wild, but it's on the retail side. It's not on the professional side, going back to your point.
Well, it's interesting. There's a lot there, a lot to think. There. I mean, it's an interesting discussion, and we saw GameStop that goes up a lot. They can come back a lot too. And just yesterday, some historic reversals on some of these stocks. We're watching it again. Maybe there are pockets of optimism. Clearly, you can say right there with the Wall Street bets crowd reviving themselves. Maybe they never left. I don't know. I don't pay too much attention to it, but that's.
But this seems like perfectly made for them. I mean, we have a little bit of excitement on the crypto side. It's not quite on the Bitcoin side, right? Bitcoin's hovering around wherever it is, 117, 118, something like that. I mean, that's high, and it's up nicely for the year. But you see a lot of other cryptocurrencies doing well, and all of this other stuff, the stocks associated with it.
Oh, yeah. I mean, it's interesting what's going on there because like Ethereum, second largest one, doubled in 2 weeks, right? I mean, so Bitcoin's kind of going sideways down a tad, but there's a lot of money flowing into some of the other ones, which is kind of a risk on. I saw Solana. Solana's up over 200. I mean, there's some names that are moving again. All right, good stuff there. Let's see here. Retail sales came out last week. We got about 5 minutes, Sonu. Retail sales came out. The headline number came in better than expected, but when you took a look, it maybe wasn't as strong as they told us, but I guess it could have been worse. What'd you find?
So retail sales was strong, headline 0.6% month over month June, but the last 2 months are really negative, right?
Right.
So you look at the last 3 months because these things can get revised. You're looking at negative 1.4% annualized, right? Now, what was positive, you look under the hood, was food services. It was up 0.6% in June. Last 3 months, it's up 5.4% annualized. But here's the thing. This is nominal, right? Remember what I said about food away from home, seated dining. Right. All of that stuff is up close to 5%. So what we are seeing is real sales are pretty much flat. People. It tells you that people are spending, right? That's what the nominal sales tell you. But they're just spending just about enough to keep up with wage growth, things like that. And they're not increasing the rate of growth of their spending. That's the story here, right? They're just about able to keep up with the higher prices, inflation that you're seeing in food prices, seated dining, things like that. But that's it. They're not, increasing it much above trend or anything like that. That's a big picture.
So, that makes sense. I mean, again, the economy... we said in our outlook potentially could slow the second half of this year. There's parts of it, but again, is the slow equal recession? No. Does slow equal massive trouble? No. Just simply slowing, and that kind of shows that. Last chart I wanted to touch on. We'll put it up now. The idea of productivity. I've used this story before. We can put the chart up. Productivity per worker. A revenue per worker, an amazing chart by Bank of America, just showing again on S&P 500, Sonu, all-time high. And the previous times we had PCs, the internet browser, mobile data, cloud services, and now big data AI taking place. So again, companies are making more revenue with, you could say, less employees or the same amount of employees, but they're making more revenue per employee is the best way to put it, which again is productivity. I've made the joke before. I could be on an airplane. My boys can lock themselves out of the house. They can send me a text while on an airplane, say, Dad, we locked ourselves out, open the garage door. I can push a button on my phone, open the garage door. Well, that takes 15 seconds. I don't know how you measure that type of productivity, but it's happening in everyone's lifetime every single day. And then you see an amazing chart like our friends at Bank of America shared, which again, revenue per worker continues to soar. And you think to yourself, those previous big times kept going higher a lot of times after these new revolutions came out. AI, we know about as much as the next person, but obviously a lot of smart people like our buddy Dan Ives thinks this is, what does Dan say? We're about midnight and it's a 5 a.m. party, something like that.
Like 97, 97, something like that.
Yeah, so there's still time. What'd you think of that chart though when you saw it? I thought it was, I've heard the story before. I thought it was really cool. I don't know.
I like that. If you look at the areas where it's really surging upwards, right? You've had three big, revolutions, or revolutions too strong of a word. But technological innovations, right? Yeah. In the 90s, it was the internet, PCs, things like that, right? Everyone started using a PC at home in the 90s, and then laptops, all of that. And then in the mid-2000s, it was financial innovation. Of course, we know where that got us. The CDO squares, etc.
That didn't work.
But, no, exactly. But financials and energy too, at that time, became a large part of the S&P 500, and then you got a collapse. Right? Yeah. Energy went through 3 or maybe 4 bear markets since 2008, 2007. But now you have AI. You have another technological revolution / innovation, things like that. And you're seeing that surge with technology making 45, 46% of the index. I mean, I know they split the sectors and things like that, but realistically, Energy is close to half the S&P 500, right?
Or not energy, to technology.
You technology, yes.
That's all right. Yeah.
And they don't hire a lot of people.
Mm-hmm.
That's just the reality of it. You're talking about industrials.
Right. I mean, every January, technology companies lay off a bunch of people. The media go wild. Everyone talks, the economy's cracking. And you and I say, well, every January, technology companies lay off people. Then they do hire throughout the year, but that's just something to think about. If you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We love your feedback. Also, great news on the YouTube channel. We now have the comments on. We never had them on before, but thanks to everybody who kind of pushed forward there. So feel free and leave comments. And we even like bad comments, because bad comments, when people come back and defend us, and our friends at Ritholtz have said that's really nice, because you just want that algorithm to take off with comments on the YouTube channel. So feel free and leave some comments there as well. All right, so I know we are at the end. You got to take care of your kids this week. What are you watching? Earnings? Anything else? What's happening?
Not much. I'm looking forward to, just spending the last month of summer, just chilling for the most part. So yeah, there's not much important on tap. Other earnings. I mean, I think Google reports on Wednesday, and a few others, and next week is another big week. So once we cross that, then we get to August 1st, which is obviously tariff day again.
Yeah.
So trying not to think about that.
Liberation Day 2.0. Today's the 22nd. I think my kids start school August 22nd. So you're talking. We're down the
same thing with me. I think they're I think my kids start on August 18th. August 18th.
Yeah, 22nd. I'm pretty sure 22nd. It's a Friday. Yeah, they start on Friday, which is really start on a Friday, but whatever. Just
why did they do that?
Who knows? Who knows? Who knows why people do what they do? People are irrational. That's what we do a podcast talking about that every single week. So I don't know. Anyway, all right, everybody. Well, hopefully you enjoyed it. We have hit literally the last 2 weeks the most downloads we've ever had on this podcast. A lot of new listeners, and again, thanks to our friends over at Ritholtz, Compound and Friend, for helping us push a little more to more listeners. But we really appreciate it. Again, likes, follows, comments, all that stuff helps us. You want to help us build this podcast bigger and better, do that, and we will continue to do this every single week. And Sonu and I, this is how smart we are at math. We're at 145. We've got 150 coming up, and we said we need to do special. We don't know what we're going to do yet. We've got 5 weeks to figure something out, kind of special to do for episode 150. But all of that, this is episode 145 of Facts versus Feelings. See everybody next week. Have a great rest of this summer. Go do some vacations, have some fun. See everybody soon. Take care.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.